So, what is Forex trading? Forex is an abbreviation which means foreign exchange. The foreign exchange market is a global marketplace for exchanging national currencies. It's the simple act of buying and selling currencies, just like when you fly in from your country to another country. To be able to use your money in that country, you will have to sell your money in an exchange market there, and then buy the currency of that particular country. This is the normal way of money exchange, but when we are trading Forex on our computer, we no longer want to buy and sell. We want to make profits from buying and selling. But you are not the only one that wants to make money from the market. You have a lot of competitors, people with more money than you can ever imagine. I am talking billions of dollars. The central banks wants to make money from the market. The institutional investors, also known as the hedge fund traders, wants to make money too. The commercial banks are very hungry for this same bag you are chasing, and they are not planning to lose their money to you, not even a dime. A lot of big companies are looking to grow their company's portfolio trading the Forex market. And lastly, the brokers. These ones don't even need to invest their money into the Forex market before they can make profits. I will tell you how they make their money later in this video. And don't forget, there are also many individuals like you who wants to make money from the market too. They are called retailers. All these are your competitors, and you are going to be trading the Forex market with them or against them. And that's where the game gets hard, because they all want the same thing that you want, the profits. And none of them, I repeat, none of them is ready to back down and give you an edge to make profits in the market, or any useful information regarding their next line of action. You are on your own. But you are not alone, as I will be guiding you through this episodes and showing you everything they do to make profits. Make sure you don't miss any of these episodes, as I will be revealing a lot about their secrets, so that you can also join them to make profits from the market. Now you may be wondering, why should I trade the Forex market? I will answer that quickly. Though the Forex market comes with a high risk, but here are some of the few reasons I will advise anyone to trade Forex. 1. The Forex market is the largest and most liquid financial market in the world, with a daily trading volume of more than $6 trillion United States dollars. And this high liquidity means that anyone can enter and exit the market with ease, and without any significant price movement. 2. Unlike stocks and commodities, the Forex market is available for everyone to trade, with very small capital, even as low as $1. You can also participate in the market, a big advantage, which is not found in stocks and commodities that requires you to deposit a bigger amount of capital for a start. 3. The market operates 24 hours in a day, from the opening at 5 p.m. on Sunday to the closing at 5 p.m. on Fridays, New York time, and throughout these 5 trading days of the week, the market will be opened for 24 hours. That means you can trade in the day or at night, from anywhere around the world. It does not matter if you are living in the village or in the city. It makes no difference if you are living in a hut or inside a duplex. As long as you have a phone or a laptop with a good internet connection, then you are good to go. 4. Forex trading provides an opportunity for traders to benefit from both the rising and the falling market. If the market moves up, and profit, and if the market moves down, you can also profit from the market, unlike other markets, where you can only make profits when the market is moving up. Now, in order to trade the Forex market, you need to know exactly what you will be trading with in the market, and you don't need to complicate them. The different currencies that you will be trading in the market are quoted in pairs, and they represent the relationship between two currency pairs. These currency pairs are divided into three different categories: the major pairs, the minor pairs, and the exotic pairs. The major pairs are the most traded currency pairs in the market. They contain the highest liquidity and daily trading volume, meaning that more money is traded in the major assets than in the other categories of currency pairs. The major currency pairs include the Euro, US dollar pair, the US dollar and Japanese yen pair, the Great British Pound, and the US dollar pair, and more. They are also more volatile than the other pairs. The minor pairs are the lower version of the major currency. I said lower because they trade with less trading volume than the major currency pairs. But don't get it mixed up. It is also liquid and volatile, but has less trading volume than the major currency pairs. They include the Euro, Great British Pound pair, the Euro, Japanese yen pair, the Great British Pound and Japanese yen pair, and more other pairs. The last category is the exotic pairs. This category is a no-go area for traders. They are very risky and less volatile, thereby putting traders who trade them at more risk than usual. I will advise you never to look into or trade any pair in this category. And I know by now, you may be asking me, what about gold? Is gold not a currency pair? Gold is not a currency pair, but it's a quoted pair in Forex trading, where traders can trade the price movement of gold, even when they don't own a single piece of gold. And in one of the next episodes, I will be teaching you on how to trade gold USD, and I will be revealing to you the best currency pairs that I recommend for every trader, and the ones you must avoid even among the major currency pairs, if you want to make money from the market. Now, in order to trade all these currency pairs and more in Forex, we need the help of one of the entities that I mentioned earlier in this video, the brokers. The brokers serve as an intermediary between you and the foreign exchange market. They help to fill in the gap for you. There is no way you can trade the Forex market as an individual or a retailer without using a broker. A broker helps to manage your trading activities like buying and selling, deposits and withdrawals. They make their profits from the commissions they get on each trade you take in the market. They are like the middlemen between you and the market. Either you make profits or loss on your account. The brokers will still be making money regardless, but some brokers are just way too greedy, that they find ways to take too much money from their customers. And because of that, we are not going to be using just any broker. We want a broker that is transparent and more beneficial to us, giving us a chance to make more money comfortably from the market. I will be leaving a link to the best brokers I use for myself and my clients in the description box below. Sign up and get your account ready. Signing up with a broker is as simple as creating a social media account. But make sure that all the details you input are correct about you and are also represented on your identity cards in order to ensure smooth registration and usage of your trading account. And after that, you are one step closer to becoming a millionaire in Forex trading. Now let's continue. In order to start trading Forex with your trading account, you need the basic things. 1. A smartphone or a laptop, but more important is your phone, because that is what we will be using to take our trades and also to make our analysis. We can actually do without a laptop, but we cannot do without a phone, because that's where all our trades will be executed. But although you can take a trade with your laptop, which is very confusing, it is more easier to trade on your phone. Use your laptop only for analysis. The second basic thing you will need is a good internet connection. Either it's a Wi-Fi connection or a mobile network connection. Make sure that you have a very fast connection each time you want to trade. Very important, because the apps and softwares we will be using needs a strong internet connection. If your network is slow during trading hours, it will affect your trade executions. That means you will not be able to place a buy or sell position effectively, and this will make you miss a lot of golden trading opportunities, all because your internet connection was slow and before your network finally take the trade. The market could have moved a lot beyond your trading price. So take note of that as we move on. Now, let me introduce you to the apps and softwares that we will be using for our analysis and for taking our trades. 1. MetaTrader 5. If you have been seeing traders showing you something like this is the app they are using, MetaTrader 5. I will be showing you more on the app and how to use the app effectively as we progress. The second app you will be using is called TradingView. I am sure you must have seen traders showing you something like this. Okay, this is the app they are using, although there are other apps like this, but hey, you don't need them, as this is the best app for analysis, used by all traders worldwide. Now, follow me, as I will be showing you how to use these apps for better trading results. In order to download MetaTrader app to your Android phone, go to Google Play Store and download it to your phone. And for iOS users, go to your App Store to download it. In order to download the software to your computer, head over to metatrader5.com to download the software into your computer. And from there you can install and you are good to go. After installing MetaTrader 5 on your device, the first thing to do is to log in into your trading account. You do that by clicking on the Get Started box. This page will appear. Then you click the plus icon and you will enter a page where you will be placing your personal account details, which have been assigned to you by your broker. Those details can be found in an email address sent by your broker or in your account trading dashboard. When you are successfully logged in, you will see a new page like this. These are on this. You will see all the currency pairs and other assets you will be trading. They are called quotes. If you want to add other assets to your trading dashboard, you click on this Add button. And from there, you can select any of the currency pairs and other assets which you desire to trade, and they will appear on the quotes dashboard. When you click on this edit icon, you can select and rearrange the position of the quotes, placing one above the other, or placing one below the other. And you can also use it to select any asset that you no longer want to trade, and delete them from your quotes dashboard. When you click on this, it will lead you to your chart, where you are going to be making analysis, or you can use TradingView, as I will be showing you later in this video. And on your chart there are different tools you will use. Follow me as I give you a quick tour, showing you around the chart. The first cross symbol is your crosshair. The second symbol is used for adding indicators, such as moving average, Bollinger Bands, parabolic SR, and a lot more. The third symbol will help in displaying other time frames, that is, if you want to change your time frame. The fourth symbol is used for placing buy limits. That means you can set up a trading order and wait for the market to touch it and open a fresh trade. I will be explaining more on that towards the end of this video, when I will be teaching you on how to place your trade on your account correctly. The fifth object is called one-click trading. It is used to place a lot of trading positions at once. A very risky one, but it saves time when you want to place multiple trading positions. But I will always advise you to close it when you are not ready to take a trade, so that you don't mistakenly click on it and open a position you never intended. These are the upper trading tools, but when you click on the chart, you will see this rotary tool. The first thing you will notice is the trading time frames, which you can easily switch with it. But there are some other tools, so when you click on this, you can open a new chart window, giving you a new chart. When you click on this, you will see different objects, like the trend lines and many other objects, which we will be using for analysis in the next episode. When you click on this, it will lead you to more advanced settings on your app, including where to change the color of your chart and the candlesticks. This is the view of your trading account, your balance, and where you will see your trades if you open one. This will show you your trading history. In order to download TradingView to your devices, follow some instructions I gave out to install MetaTrader 5. The only difference is that this time, you will be downloading the setup for your computer from www.tradingview.com. There you can download it and install on your computer. TradingView does not actually need your trading account details. All you need is an email address to sign up, and then you have a new TradingView account. Let's go on a tour in TradingView real quick. So here you have your quotes, just like in MetaTrader 5. You can add any trading asset using the plus icon. Just type the name of the asset on the chart, and they will show up. Most times the charts can differ, depending on the broker. Pick any one of them, and you can start analyzing immediately. Now, you are on your chart. When you click here, you can change the time frame of the chart. If you click here, you can add any object to your chart, like the trend lines, horizontal line, and more. When you click on this, it will lead to a page where you can change more chart settings, like changing the color of the chart, changing the chart type, and a lot more. If you click on this, you will see a page where you can add indicators, trade alerts, and more. TradingView is very easy to use, and I will advise you to use TradingView more for analysis, and then use MetaTrader 5 to execute your trades. Now, let's go back to MetaTrader 5 to take our first trade. A lot of things have evolved, and there have been a lot of new updates to MetaTrader 5 for better trading, and because of that, we are not going to be doing things the old way. In order to take our trade, we will be using the one-click trading and the trading limits tool. In order to take your trade, all you need to do is to input the lot size, and you are good to go. For this example, I will be using the smallest lot size, because I am trading this on a real account. So when you have placed your preferred lot size in the box, you go ahead and click on buy or sell. For this, I will be using 0.01 as my lot size. If you are not clear about lot sizes and how we calculate it, don't worry. In one of these episodes, I will be teaching you on how to calculate your lot size in such a way that before you take a trade, you will know the exact amount of money you will make or lose in a trade. Now, after you take the trade, you will see the trade running on your app's trading account dashboard. Welcome to the trading life. Now, if you want to close the trade manually, you long press on one of the trades, if they are plenty, and these options will appear. Choose what you want to do. You can close all the positions at once. You can choose to close only losing positions. You can close only buy positions, or specifically close the positions of one particular currency pair, in a case where there are many trades of different pairs. The options are always clear and self-explanatory. Now that you know how to place your trade and the apps you will use, you don't want to just take any trade at any time you like on the chart, else you will just be gambling away your money and feeding the brokers. There are only two ways to trade the market. We trade the market using technical analysis and fundamental analysis. There is no other way. Technical analysis is the act of analyzing the Forex market using candlesticks in order to analyze the key levels, chart structures, and the overall movement of the market for the sole aim of profiting from the ups and downs of the market. When you trade with technical analysis, you are called a technical analyst, and all your decisions are based on what the market price is doing at that moment, using a concrete trading plan carved from repeating patterns on the chart based on trading history, and we call this a trading strategy. When we trade the Forex market, based on technical analysis, we are either looking on trading the trend, trading the key levels, or using indicators in order to identify these two patterns correctly. We use a lot of trading tools for technical analysis, but here are the most popular and most important tools for analyzing the market using technical analysis, and these patterns will give us crazy profit in the market if we use them correctly. First is the trend line. The trend line occupies the top spot for our technical analysis tool. They are used to identify the current trend of the market. If the market is moving down consistently, we can say the market is trending down, and we call this a downtrend. We focus on using the trend line to find us a good spot in the market, where we can enter a sell trade in respect of the current trend of the market. And when the market is moving up consistently, we consider the current trend of the market as an uptrend. And this way, we are looking to enter a buy position at a very good spot in the market, considering the fact that the current overall movement of the market is in an uptrend. The second tool is the horizontal line. The horizontal line is used to identify the key levels in the market. Key levels like the support and resistance, and the supply and demand levels. The key levels are those areas where there have been a good price movement on the chart. And we expect the market to return to those levels and take the market down or push the market up, because we traders believe in history to always repeat itself while trading. And that is why these key levels are very important. The third object is the rectangular box. It is also used to mark out key levels, but mostly used to draw out order block zones. Order block zones are those areas where the liquidity of the market is stocked in. It is analyzed following the trend, like the trend line, but it is traded differently. The rectangular box is also used to trade supply and demand levels. I will be teaching you a lot of these strategies in the future episodes. Now, finally, the indicators. The indicators are used to smoothen price movements and to understand the market. Based on the algorithm of the indicators, the most popular indicator is the moving average indicator. The moving average smoothens the price movement and helps us to understand the current trend of the market. When the candlesticks are moving above the moving average line, the market is considered to be in an uptrend. And when the candlesticks are moving below the moving average line, the market is considered to be in a downtrend. We have also more effective indicators, such as the RSI indicator, Bollinger Bands indicator, MACD indicator, stochastic indicator, and many more. These indicators works with levels, crossovers, and some other features, which we can use to analyze with them. Follow me carefully as we move to the other side of trading analysis. This type is very risky, but also very profitable. Although everything in life is risky anyway, it is called fundamental analysis. Fundamental analysis is the type of trading analysis that involves the act of using economic, financial, and social news or sentiments to influence your trading decisions. These type of analysis involves you trading only based on the news, economic reports, and specific trading hours. This is actually the easiest form of trading, because you don't need to analyze a lot of candlesticks before making a trading decision. But it will also take a lot of research to become a profitable fundamental analyst. To become a fundamental analyst, there are factors that influences and shape your analysis and your trading results. Here are those factors. 1. Economic indicators. Economic indicators such as inflation rate, interest rates, and unemployment rates can highly affect the price movement of the affected currency. When there is a very high inflation on a currency pair, which is paired with currency of the affected country, there will be a very big impact on the price movement of that currency. Let's imagine there is a high inflation on the US dollar. Every currency pair or metal where USD is paired with, such as USD, JPY, Euro USD, GBP USD, and even Gold USD, will be highly affected by the inflation. This can cause a very high impact on the price movements on the chart. Sometimes you can see a very long spike or price movement like this on your chart. This is what I am talking about. They are from the result of the impact of the fundamental news. The other economic indicators, such as the interest rates and unemployment rates, also have a very high impact on the market, sometimes even bigger than the one that you can see on the chart right now. And there is always one big heat like this, almost every week in the Forex market. The impact is so strong that if a technical analyst is not aware of this before it happens on the chart, it can work with or against any trade he or she is trading at that particular time in the market. But here is the good news. All this can be avoided or traded even before it happens. Before the end of this video, I will be showing you a website where you can get this news information forehand and know what will happen even before it happens, so that it won't take you unawares or come as a surprise when you see them moving on the chart. There are other news or factors that move price like this. They include fiscal policy, such as the government spending and taxation. We also have political and social factors, such as elections, government stability, trade wars, and natural disasters such as earthquake, hurricanes, flood, and even war. So anytime there is a big natural disaster occurring in any currency related to the pair you are trading, you must make sure to look out for the impact on your chart. The natural disasters, which includes wars and the others, often lead to a high decline on the currency value, and sometimes they lead to a very low volatility, making the market move very slow. Like during COVID-19 epidemic, almost all the currency pairs were moving very slow and almost static, and a lot of traders had to avoid their chart at that time, waiting for the better days, in order not to make much losses and save their money for the rainy days. Another way of trading using fundamental analysis is by trading with the major Forex market hours, such as the Sydney session, the Tokyo session, the London session, and the New York session. And we also have the overlapping sessions. And many traders believe that trading at that particular time in the market will make their trades move better with more volatility and a lot of other sentiments. And if that is true or not, we will find out in one of the next episodes. In order to get fundamental news before they happen on the chart, we will be using a Forex website called forexfactory.com. This website keeps you updated on the future fundamental news that will greatly affect your trading. You can see they are marked in different colors and the exact time the news will be released. As a technical analyst, you can ignore the other colors, but don't joke with the red ones. Beware, they are very volatile, and even among the red ones, there are news more volatile than the others, the ones capable of causing panic on the charts. If traded wrongly or ignored completely by any trader, you will really pay for it with your hard-earned profits. And all these I will be teaching you as we progress in this video. So when you are in a chart like this, you don't just start to look for the next available spot to enter a buy or sell trade from. You must know the perspective from which you are trading from, because while the different charts might look the same, they all have different impacts on the chart. The chart is divided into segments called time frames. The trading time frames shows you the overall price data of price movements on the chart at a particular period of time. For example, we have the 4 hours time frame. On the 4 hours time frame, the price chart is formed on the movements of the candlesticks that formed within a 4-hour period. This involves the opening, the closing, the highs and lows of the candle. Everything happens within a 4-hour period. There is no special way to know that a particular chart was formed with candles which formed within a 4-hour time frame, because they all look similar with just different structures. The only way to know the time frame you are currently working with is by changing it on the app or software which you are using to trade, and I know you all can do that by now. The higher the time frame, the wider your profit margin or risk management will be, and the more capital you will need to trade. We have different types of traders in the Forex market depending on the time frame they trade. We have the investment traders. These ones are looking to hold a trade for a very long period of time. They can hold trades and keep them open for 3 to 12 weeks. In order to analyze trades for their long-term goals, they use the weekly or monthly time frames to analyze their trade. We have the position traders. These traders can hold trades from 1 to 4 weeks. They also aim for long-term profits. They use the weekly and daily time frames to analyze their trades. We have the swing traders. The swing traders can hold trades from hours and days. They make use of the 4-hour and daily time frames to analyze their trades, and sometimes even use the 1-hour time frame to find good entry spots. We have the day traders. The day traders focus on short-term investments. They focus on the intraday movement of the market. They use smaller time frames like the 15 minutes and the 5 minutes time frame. And lastly, we have the scalpers. Scalpers are the fastest when it comes to trading. They can go in and out of the market in minutes and sometimes in seconds. They want to take advantage of the small movement of the market, so they use the 1-minute time frame to trade the market. All these traders have different goals for their trading activities. The higher the time frame a trader takes, the higher the capital they will need to hold their trades. And this means they will be making higher profits or higher losses depending on the time frame they trade. If you are just starting out, I will advise you stick to the 15 minutes and 5 minutes time frame. And as you grow and your money grow, you can choose to either elevate to the bigger time frames or stick with the time frames that made you. But no matter the time frame you are trading with, there is one thing that will determine the amount of profits or loss that you will make while trading. It's called the lot size. The lot size you can trade depends on the amount of money available in your trading balance. Each time you want to take a trade, you must take your time to know the lot size you will be trading your money with. The standard tradable lot size in Forex ranges from 0.01 to 10.0 and even more when the account size gets bigger. They all carry different levels of risk. For example, if you have a trading balance of $50, you can't trade with a lot size of 1.0. In fact, your broker won't even allow you to open that trade because they have a limited leverage for each account according to the balance. Even if you were allowed to open a position with that, you will see your money disappear in seconds, and it will look like magic. In fact, many people have lost their account because they mistakenly use a big lot size, or maybe out of greed. But hey, since we know that lot size is a very important part of your trading account, how do you calculate your lot size so that you don't fall into these mistakes that other traders make every day? Okay, first of all, you must understand that the value of a lot size is calculated in pips. Pips is like the value of price movements on the chart. So when a price of a particular currency pair or metal moves like 100 pips, you can calculate it with the lot size you will be trading with, and it will give you the exact amount of money you are going to make or lose on that trade. Let's see how we calculate pips on the chart. In order to know the amount of pips you will make in a particular price move, you will open your crosshair. Hold it at the beginning of where you want to calculate it with one finger and use another finger to adjust the crosshair to the second point. Any number you get after the zeros is your pip value, and for this the pip value is 1296 pips. You can then multiply it with your lot size to know your future profits or loss. But thanks to the new updates of MetaTrader 5, you can actually know your future profits or loss in just a few clicks. Type your lot size on the one-click trading box, then use the limit trading option and move the icon to the point you want to buy or sell. Then you can tap on the stop loss or the take profit icon to understand how much you will make or lose in the trade. You will know exactly how much you will make or lose in the trade. And that being done, let me teach you an easy strategy that you can start analyzing with on your chart in order to make easy profits daily. It is called the pullback strategy. When we are trading the pullback strategy, we think of the market as moving in progression. So the market will break a key level like this one, where it is supposed to touch and fall, but instead it moved high and then returned to that key level again. But this time the goal is to touch the key level and continue moving higher and higher. It is in that return that patient traders wait like a sniper to take their trade from there and hit a very big target. When the market finally return and touch that key level, we will take the trade from there. Let's take a look at another example. So here you can see that the market broke this key level, and after that moved lower, and then returned to touch that particular key level again. This pattern happens in the market almost every day on different trading assets. If you were using the smaller time frames, like the 15 minutes and 5 minutes, and you can take advantage of it each time you spot it in the market on your chart, all you have to do is wait for the market to break the key level, and then wait for it to return to that key level again. And there, you will position like a sniper to take the trade immediately it touches the key level. Check out this example. Here the market has done the major three things that I talked about. It has broken the key level, it moved higher, and here it returned to the key level again. When these three moves have been done, then it's time to enter the trade when the price finally touched the key level. And for this, we are placing our stop loss some few pips below the entry point, and now take profit target at the next high, or some few pips above the next high, just like I did here. After that, you wait patiently for the trade to play out, and there you have your take profits matched. This strategy is very easy and a 10-year-old kid can understand it. But the fact that it is easy does not mean you should joyfully enter your chart and start trading it in your account immediately. You must first calm down and go back to your chart and start looking for where this pattern has happened before, so that you can master it completely. It is said that practice makes perfect, and it's not guaranteed that every time you trade this pattern that you are going to win all your trades. But if you take your time to practice it on your chart by looking for more examples on your trading assets, losses will be few, and you will be surprised on how effective it can be as you trade it. By now you should know that we have different segments of currency pairs in the Forex market: the major pairs, the minor pairs, and the exotic pairs. And we also have other trading assets, such as the metals, which involves gold, silver, and other metals, which you can trade. All these currencies have different grades when it comes to trading, such as their volatility, the neatness of their price movements, their spreads, and more. Take a look at this chart. Any trader will have a hard time analyzing this type of chart. Then, what do you expect from a beginner? This type of price movements can frustrate your mental progression, and trading has a lot to do with your mental focus. That if you focus on pairs that has this type of price movements repeatedly, you will have a lot of mental stress for real. This chart is not a clean chart, and if a currency pair or any asset has this type of price movements repeatedly, it should be avoided at all cost. Take a look at this second kind of price movements. The other one was full of gaps, but this one is full of wicks. We call this choppy price movements. This type of movements does not allow traders to enjoy a smooth price movements at all in the market. 1 minute you are in profits, and another minute the market is coming for your stop loss. These price movements are traps that should be avoided by all traders, and if you see their type of price movement on any currency pair that you want to trade, let it go. It's not worth it. Those kind of currency pairs do not deserve your investment. The kind of price movements you should want to trade if you want to enjoy better trading opportunities are price movements like this one, the smooth trending price movements that has less choppiness over time. It's not like a market will be completely free from choppiness all the time, but there should be very less choppiness and more smooth price movements. This is the kind of chart that you will enter, and you are more comfortable of where the market is heading to. No too much up and down movements, and there is no confusing gaps, just pure price action. Another thing to consider before selecting an asset to trade is the spreads. Some assets always have more spreads than others. Take a look at this currency pair. Look at the wideness of the spread. The brokers make more money when they are wider spreads. That's why you get an instant loss each time you take a trade. Those are the commissions for the broker. Sometimes the spread are so little and tight that you may not even notice it when trading. But when the spreads are just a wide, like this, almost all the time on that trading asset, that is a big red flag, and you should consider dropping that asset for a better one, because you will make lots of unplanned losses. The trading strategy might be good, but the spreads will lower your profits. So when you are checking out for trading assets, there are 3 things you should consider before trading them. Number 1, you must make sure that the market is free from many gaps. Number 2, you must ensure that the chart is moving smooth and free of plenty choppy movement. And number 3, you must make sure that the currency pair has tighter spreads in order to ensure a better risk management. And these qualities are mostly found among the major currency pairs, as they have more volatility. And we can also find these qualities in metals like gold and silver, and also among some of the minor pairs. And like I told you all before in episode 1, trading the exotic pairs is a big no for me. Here are some of the currency pairs I recommend for trading. I like to trade USDJPY. I trade GBP USD and Euro USD, USD, C. AD is interesting too. And for the metals, I trade gold and silver. There are many other currency pairs that are great for trading, but these are among the ones that I choose for my daily trading. They may not be the ones you should trade, but each time you are looking for multiple assets, make sure that they follow the 3 simple criteria that I laid out earlier, so that you can be assured of getting better opportunities, less risky trades and more profits to your trading account. They are just so easy to identify. If you choose very good time frames for your trading account, a very big portion of your trading issues have been resolved already, and your journey to success as a successful trader is inevitable. And the next thing you need now is another beautiful trading strategy to help you grow in profitability. In fact, this is the easiest and the most profitable trading strategy that I use. Here is how we trade it. So on the chart here, you can see that the market is trending up. And if the market is in an uptrend like this, we want to find a good spot in the market where we can enter the trend from. And there are 2 ways to do that, using one trading tool. It's either we enter from the beginning, or we enter when the trend has been fully established. And to do that, we will be using the trendline tool in order to enter the trade from the beginning. This is what we should always look out for. It is a 3-step move. So here we have the first step, the second step, and the third step movement. When you see these 3-step movements, it's safe to say that the market is about to take off on a new trend. And in order to catch on, we draw our trend line, connecting the 3-step moves together. And that's how we will be able to get the next available spot to join the trend and make profits. So when the market touches our trend line, we take our trade from there. We hit the buy button and then wait for price to move to our target direction. But here is something you must not do while drawing the trend line. You must never draw it on the body of the candles. You should only draw the trend line on the wicks or inside the wicks. If you draw it on the wicks or inside the wicks, you will be able to filter out many premature trendline touches, which will greatly reduce our losses after we place our risk management levels. For the right move, when it touches the trend line and you have placed a trade, you place the stop loss a few pips below your entry level and your take profit target at the next high. But for a trade where the next high is not close, or it's nowhere to be found, we make our take profit 3 times higher than our stop loss, giving us a 1 to 3% risk, meaning that you are risking 1% of your capital to gain 3 times more than your risk. Now, when the market has moved high, we can then extend our trend line in order to catch more future trend moves. Let's see another example. So here we can see the 3-step moves. Look into it if you can see them already. We have here the first step, then the second step, and finally the third step. This makes our trend move complete, giving us a good trend line. Drawing the trend line on the wicks of the candles and making sure not to touch the body at all. This way, we were able to catch the next available flight to take off with the uptrend moves when the market finally retraced and touched the trend line. And then I will place my stop loss somewhere here, and then place my take profit at the next high, since I have a good available high at the top here. And if you took this trade, it would be a celebration. hitting your take profit target successfully. This happens many times on your chart, every new week. You just have to find them more on your chart, stay on it, visualize it, and then begin to identify them on your chart every day. And as time goes on, you begin to master it and be making more profits with it. This strategy works on all time frames. It works for swing traders, day traders, and even scalpers. If you are a swing trader, use it on the 4-hour time frame. For day traders, focus on the 15 minutes time frame, though it still works on the 5 minutes time frame. And if you are a scalper, you already know your time frame. Make sure to use the risk management plan for all your trades, setting your stop loss and your take profit at the right spots to avoid unnecessary losses. First of all, what are entry candlesticks? Entry candlesticks are those specific trading candles that gives us a go-ahead in the market in order to either buy or sell the trade. These candlesticks are the last thing we wait for before taking a trade. They decide for us the fate of a setup, choosing either to enter the trade or to ignore it completely. In the market, we have levels of trading, and those things that we look out for before taking a trade. First, we look out for the overall direction of the market, then the market structure, and finally the entry candlesticks. But unfortunately, many traders don't have the patience to wait for the entry candlesticks. They either place a buy limit or a sell limit, and they wonder why they keep failing. Though the buy and sell limits work sometimes, but there are many disadvantages to it. Let's imagine a sell trade is to be placed using the key level of the price movements formed on this chart, and they are two traders trying to take advantage of it, one using a sell limit order and the other using an entry candlestick to make decisions after it appears on the chart. The trader with a sell limit order will place his stop loss at the top of the key level, along with his order, as 90% of limit traders do, and before you know it, the market will trigger his sell order, and then go along to trigger the stop loss, taking him out of the trade completely. And when that is done, the market then starts to retrace down immediately to the some direction the limit trader predicted it to go correctly, but was not just patient for an entry candlestick. And here, the second trader who makes use of entry candles, who waits for just one more confirmation from the market, knows that the market just touching the key level does not mean it's going to retrace immediately, so he waits for a go-ahead before taking the trade. And see how the market moved after giving the entry candle. But here is the catch: not all candlestick are good entry candlestick. In fact, some signals a continuation move from the key levels and may not retrace. That is why we need candlesticks that will give us a better move for the market. Some candlesticks work sometimes, while some don't even work at all. But they are some that 90% of the time you find them on good trading structures. They are always bound to work and have a very high win rate. Let's see some of these entry candlesticks. Number 1 is a doji candlestick. The doji candlestick represents exhaustion. It means that as price approach the key levels or entry spots, the traders pushing the prices have grown very weak, and a reversal is bound to happen. But the thing is, the doji candle on its own cannot work properly and can give us a lot of false signals if traded alone, because as it represents exhaustion, it also represents indecision, a balance between the buyers and the sellers. So in order to get the best out of it, we will look out to trade it when we see them with momentum candles, and that is where the morning star and the evening star formation comes to play. These two entry formations are widely known by a few profitable traders. They show us the final defeat among the balance between buyers and sellers. So when we are targeting to sell a trade and the evening star entry formation shows up on the key level, we will enter the trade. And when we want to buy a trade and the morning star entry formation shows up, we will see that as a good sign to enter the trade. The second entry candlestick is a pin bar. The pin bar is also called the hammer candle or the shooting star, depending on the direction, is one of the most popular entry candlestick amongst traders, And it's not just popular for no reason. It helps us to identify when the market is ready to continue moving, mostly used for trending markets than in a ranging market. The trend line shows us that the buyers or sellers have had enough and are ready to push the market to their target direction. When the trend line appears with those long declines, it represents those huge aggressive rejections from the opposing market direction, and that makes it a high winning potential entry candlestick when we find them on our entry. The third entry candlestick is the engulfing candlestick. These patterns represents the full power of the buyers or sellers and their determined move to push the market lower or higher. The engulfing candle overshadows the previous candle completely, both the wicks and the candle's body. They take full control of the current market conditions, and when found at the key levels, they are a very powerful sign to enter the trade and make money from the market. Now, let me show you some examples where we use this entry candlestick on the chart. So on this chart here, we have the key levels. On this key level, the buyers are trying to push the market up, following this first move here. So we can fully call this a good demand zone. Look how the market behaved when it touches the zone. First it gave a bullish candle, but that bullish candle was not able to push the market up because it was weak and not a good entry candlestick. So it didn't have the momentum or power to push the market up. So the market came down again, following that candle, and all of a sudden, we have an engulfing candlestick. The engulfing candlestick shows us the full power of the buyers and their intentions to start pushing the market upward. See how the engulfing candlestick fully engulfed the previous candle, from the high to the low, engulfing both the body and the wicks, taking full control of the market, and from there, the market continued moving up in an uptrend. The power of entry candlesticks. Here is another example. So here we have a trending market. The trending market moved, making the three-step move that I taught you earlier in the other episode. So here we have the first step, then we have the second step, and then finally the third step. And after last step, and the trend line has been drawn, we wait for the market to retrace to the trend line, and then we buy the trade in order to benefit from the next trend rise. And in order to get that, we needed an entry candlestick, and on this chart here, you can see there was a morning star entry candlestick formation. So here we have the first bearish candlestick, then the doji candle, and finally the next bullish candle, giving us a clear entry signal for trading the trend line. When this entry pattern appears on your trend line, all you need to do is trade. And see how the trend moved after the entry. A successful buying trade. Now, check this out. Pay very close attention. So here we have a potential key level, and look at the market behavior toward that key level when it touched it. Here we have the first candle, which didn't work. We have the second entry trial, but that was not an entry candlestick. And finally, there was no entry candlestick found to be taken on that key level. So it just made a little buy movement, and since there was no strength to push the market further, it could not move as high as it should. And now, when it returned to the new key level that it has created, see how the market respected the bullish engulfing entry candle and moved the price up. And if you look into the chart well, you can see that the market did not move lower than the entry candle, and from there the price was able to move to a new high, since there is now enough strength to push it. That is the power of entry candlesticks. Now let's see this beautiful example. So here we have the key level, and the market returning to take orders from there and move the price up. Now see that after the market touched the key level, we had a nice bullish pin bar, which gives us a good entry reason to take a trade from there to join the uptrend movement. See the strength of the price movement due to the power of the pin bar. You can see the long rejection at the bottom from the buyers, shooting it in a very fast way with strong volatility, that it only needed a few candles to accelerate it to the top. This is a big one. And let's imagine you had placed a buy limit here, and then place your stop loss here, and the trade got executed. It could have been a big loss for you, But if you will have patience to wait for this entry candlestick, there would be less risk, more certainty and good reasons for entering the trade. And that's how you create a strong trading discipline for yourself as a Forex trader. Remember, sometimes the impact of the entry candles depends on the time frame. When you find these entry candlesticks on higher time frames, it will mean a stronger trend reversal. You can learn other trading strategies from Trading Tribe when you click on the channel icon below, as we have great and effective trading strategies with the full guides and instructions on how to trade them. Let's imagine you are on this chart right now, and you are following me carefully as I reveal these mysteries to you. As you listen to my voice, pay good attention to the chart. Let's say you saw this key level here, and you decided to wait for price to return to it. At this level, your patience is actually being tested by the market, though you had a plan to only buy the market when it finally touched the key level. And that sounds like a good plan, but there is something called FOMO in the market, widely known as the fear of missing out. It is something that a lot of traders are still facing today, and the reason for a lot of indefinite losses, not just in Forex trading, but spread across the different finance markets, including the stock market, the crypto market, binary, commodities, you can name them. Even some advanced traders still come out to talk about this weakness, but hey, it can be solved. But first, here is what it looks and feels like. So you were at this point when you drew your key level, hoping to buy the market at this point, and that was your goal, your grand plan. Then all of a sudden you start seeing the market coming down and getting close to the key level. You are starting to get tempted to enter a trade. Like, here is a pin bar, a very good entry candle to trade. At this point, some traders will start to feel like the market is about to leave them. If 100 traders are waiting on this trade, 30% will take their trade at this point, maybe because of a trade they have seen earlier, some minutes ago or some hours ago. Doing this, that went great. But what they fail to understand is that what happens sometimes is not what you should focus on. You need what happens most of the time. Another reason that will make traders do this is because maybe they have not traded any setup for the whole day, or some days, and now they are feeling bored and wants to trade. But there is nothing more stressful and boring than seeing trade figures in red, so they will place their stop loss here at this zone, while the remaining 70% are still observing the market as how price will perform from there, still thinking, should I hit that buy button? They are trying their best to control themselves, and when the market finally gets to this high, the rate of FOMO increases. The market is finally leaving them. Oh no, they have to enter now or never. So we will lose 20 more traders, and they will buy at this high. Most of them are beginners who have no market experience and just trying to make money. A rare few of them are pro traders, and they will place their stop loss at this point, or even at Thesum points with the first set of traders. Very good, they have made a wise trading decision. Now we have the remaining 50%, observing the market and thinking of their next move, because they also want this profit, but with a lower risk, and the market is testing their patience. So now the market will then retrace to this point, taking out the stop loss of the 20% high traders. A big part of them who did not place their stop loss at Thesum spot with the 30% traders, and now out of the remaining 50%, 25% will buy at this level, considering it a wise timing to enter the market, unlike the 20% traders who were not patient enough to wait. See how FOMO is making everyone blind to the initial plan. Now at this new high, another 5% will join them to trade, all placing their stop loss at this level, though some don't even place a stop loss at all. But then the market will finally come down to swipe away all of their stop loss, taking all of them out of the trade. And here is the interesting part. Just like I told you guys in the previous episode, 10% of the remaining traders are limit traders, and they will place their buy limit orders here, and their stop loss will be wiped out. This is getting more interesting, and some of you can already see what you do daily in the market as I explain them. These things are experienced by a lot of traders worldwide. And that is not the end yet. We still have the remaining 10% out of the total of 100 participants. Those who have mastered the act of patience, but they just have one limitation, the entry candles. So when the market finally touched the key level, they may think these candles are very good entry candles. It's a doji. It's bullish and all that. But hey, those are not good entry candles. So the 10% will enter a trade here, which will end up being taken out. And finally, at this spot, we have the last 10% traders, those who follow their plan, those who have mastered their patience game, and those who work with good entry candlesticks. And as you can see, here, we have one of the entry candlesticks, which I taught you guys in the previous episode, the pin bar. And that is the confirmation for profitable traders to enter their trade and make profits. Now, all that you see on this chart may look like I am just trying to teach you on how to have a good patience game and become a more matured profitable trader. But this is the harsh reality of Forex trading. This is what is happening every day across different time frames. A lot of traders are stuck repeating all these mistakes, but now that your eyes are being opened to them, make sure you don't repeat those mistakes ever again. Now, when you have entered a new trade, that's 80% work done. You still have some little things to do in order to stay ahead of the market. Because the market is not to be fully trusted, you have to cut your coat according to your size. And to do this, you need a good risk management plan. So you place your stop loss a few pips below the entry spot, and your take profit target at the next high. The stop loss will help you to cut your losses when the market moves in a funny way, and the take profit target will save your profits for you. Don't join those traders to do mental stop loss, where you will just be looking at the market and accepting anything that comes your way. Consistently adjusting your stop loss here and there will not save your money, and the market will surprise you. In fact, it is a strong proof of zero discipline. Every strategy must have an unmovable stop loss level. And each strategy that I have been teaching you on this channel has a definite stop loss and a take profit target, so that you will know exactly what you are doing in the market. And then, after placing those risk management plan, is where it gets interesting. When the market starts moving in your target direction, it's funny that some traders are not just confident about their trading plan, maybe because they have not seen profits in a while, or maybe because their last trades did not go well. And another popular reason for this is because they are trading with a very low capital. So when the market starts going their way, they have this tendency and belief that it may turn around again and hit their stop loss, so they move out of the trade early. Then after they have closed their trades, they begin to regret why they closed very early. When they see the market finally hitting their take profit target, a very nice trade wasted just like that, because a trader got scared in the process. In fact, many traders are more comfortable to see their stop loss get hit than to watch their take profit target hit successfully. Even a lot of pro traders are still going through this, and I understand it's hard to control sometimes because it deals with your emotions, and because of the popular opinions that many traders lose more than they win, and that is a trap. And the earlier you move out of that trap, the faster you will start seeing good results in your trading life. Treat your take profit target the same way you treat your stop loss emotionally, because at the end of the day, one of them will surely get hit anyway. So why the rush? This is where you start trading like a robot. The zero emotion level, you only working with logical targets and patience. When you hit about 3 take profit targets consistently, you will see a new you in trading. But to guarantee your consistent winning, this is something you should do, and one other thing you must never do. One of the major problems a lot of traders have is over-leveraging. They level up their lot size so fast when they start seeing some profits in their account. Some start doing this when they have not seen any profit in their account at all. They use lot sizes that are just too big for their account. They stack up their trades and wait for a magic to happen and turn them to millionaires overnight. This is when making profits becomes luck. But when we are trading the market, we are not trying to be lucky. We are approaching the market with strategic moves, a definite plan, and a concrete goal. For some traders, they start to increase their lot size immediately as they start making some profits. They still have that flipping mindset in their mind. But as a tribe soldier, here is what you should do to prove you are wiser and different from the crowd. Let's say you started your trading account with a $100 with a lot size of 0.01. When your trading account becomes $200, do not change your lot size just yet. Keep trading till you get to about $300 in your balance. Then you can now change your lot size to like 0.02. And from there you can keep growing and raising your account responsibly and strategically. This way you will be learning the process and getting more used to your strategy. And as you grow to bigger heights, you can just pull a little amount of money out of your balance and stack, knowing fully well that if you lose it, it will then not have much impact on your account. And you still have a large amount of money reserved for responsible trading. Now, this one is very important and I wish a lot of traders are doing it. See, no matter how much you make in trading, always remember to pay yourself. I can't stress this enough. I have seen a lot of traders raise a substantial amount of money in their trading accounts, only to lose them all in a single trade. Because of these things I just told you guys, and sometimes because of just a simple innocent mistake, like mistakenly clicking the buy button, or a lot size, mistakenly typed into the trading box, and for some, when they are just high and trading at some time, but the losses can make them get sobered up in seconds. Those are the kind of scenarios you want to prevent. I know it hurts so much to lose a single trade, but nothing hurts so much than losing a combination of multiple profits, of multiple trades, in just one single trade. Think of how it will feel. It feels so bad. So the next time you make some profits in the market, do well to make withdrawals and keep some for yourself. If you do these, it will help you stay motivated to yourself and avoid you from losing all your profits to the market. Don't stay bent on raising a portfolio. Make sure you are getting paid. That's what matters at the end of the day, tribe soldiers. And talking about getting paid, throughout this Forex trading course series, you have been able to acquire the basic knowledge of Forex trading, even onto the advanced trading techniques, on how to take good trades and manage your risk and your trading account efficiently. If you want to learn a more advanced way of trading the Forex market, like me and most of the real professional traders in the market do, and not just how to trade Forex, but to learn a complete advanced trading strategy that can work in all the financial markets, including stocks, crypto, commodities, and anywhere you can see a candlestick chart, I have a 1-month online mentorship program that will push your trading game into the great heights. It will open your eyes to a lot of things you never knew were possible in trading. Pro technical analysis, and even how to trade the news for massive profits. I have been able to change the lives of more than 240 students worldwide in the last 2 months, who are now doing very well for themselves, trading the market comfortable and making money consistently. Trading is not a game where you hope that things happen. It's a game of using strategic entries and exits to make things happen, using the unbreakable rules that money cannot say no to. To join my mentorship program, click on the first link in the description box below. My name is the Trading Chief, and it's a wrap for this video. See you in the next one.